Welcome to the session on climate finance. My name is Xiaoyan Zhou, the moderator for this session. We have 3 speakers here. Each speaker has 30 minutes, 20 minutes for presentation, and 10 minutes for questions. The Q&A period will be immediately after each individual presentation. So if you have any questions for the speaker, please write it down in the chat. Our first speaker is Dr. Dimi Rickman from University College London. She will be presenting a recipe for fast-growing wind financial market. Thanks.
Hi, can you see my screen? Is that working? Okay, I hope so. Thank you for the opportunity to speak today. As you can see, this paper has had a bit of a rewrite since it was submitted, so there's a change of title. I hope that's not caused too much confusion. So I'm going to talk today about my research on the internal dynamics of fast-growing wind finance markets. And this is a collaboration with my colleagues Francesca Larosa and Nadia Ameli, who's going to be speaking at the end of this session. And this is all under the Links project, which is an ERC-funded project hosted at UCL's Institute for Sustainable Resources. And in the Links project, what we focus on is using the tools and models of complexity science to understand renewable finance markets. So rapidly scaling up renewable energy technologies is fundamental to meeting the Paris climate targets. And wind power is set to be at the heart of this energy transition, but annual investments need to be scaled up 3-fold for onshore wind and 5-fold for offshore wind by 2050 to meet these targets. And despite financing being a very crucial part of the energy transition, analyses typically employ quite simplistic representations of the finance sector. However, renewable finance markets, like the wider financial system, are highly complex ecosystems of interconnected investors and institutions who are working within a specific regulatory and economic context. So these markets are made up of heterogeneous investors, some of whom may be more critical to the system's functioning than others. And by identifying these critical investors, this could be key to triggering tipping points in the system. What's more, their investment patterns and behaviors evolve over time due to both internal dynamics and external influences. And because of this complexity, the behavior of the system is hard to predict at an aggregate level, as macro patterns are emerging from the micro scale behavior of all the individual investors. So effective policy to scale up investment in wind finance should be based on an empirical understanding of this complexity. So in this project, we tackle the complexity by modeling wind finance markets as networks of investors and their co-investments on wind assets. And in the first part of this talk, I will present a descriptive analysis of these investor networks, firstly looking at the relationship between investor heterogeneity and network dynamics. And just as a preview of the results, what I'm going to be showing you is that markets with a high proportion of private lenders show activity that's concentrated within a small group of critical investors. I'm then going to move on to look at how these network dynamics are connected to the overall growth of the market. And what we find is that in fast-growing markets with strong private banking sectors, these critical investors are financing at least 40% of the investment activity. In emerging country markets, however, there's a different set of dynamics that we see as a pathway to fast growth, where financing is more supported by the public sector. And then in the second part of the talk, I'm going to introduce a mechanistic model of network evolution, which describes how investors behave in these fast-growing markets. And what we find is that investors rise to these critical positions through a financial learning process, which we suggest triggers virtuous cycle of investment and market growth. So our analysis is based on a dataset by Bloomberg New Energy Finance, which reports transactions on wind assets between 2000 and 2019. And each entry for a transaction is associated with a specific wind project, the date of the transaction, and the investors involved in the transaction who are labeled as either debt or equity providers. So in recent years, project finance has become one of the dominant financing structures for wind assets. And this is where typically 70 to 90% of the capital comes in the form of non-recourse debt from banks, backed up by the cash flow of the project itself. and the remaining finance is equity provided by typically the energy company developing the project. And because of this, banks are playing an increasingly important role in wind finance markets. In 2019, project finance accounted for 70% of investment volumes. So to capture this landscape, we chose to represent the investor networks in this bipartite structure, separating debt investors and equity investors into two independent sets of nodes. So co-investments between the debt and equity investors, which represent these financing agreements, appear as links in the network. And the degree of a node which is equal to the number of links connecting to it, represents the co-investments made by an investor. So the coverage of the BNEF data is very good. In most cases, for each country, it's actually reporting more installed capacity than other trusted sources like IRENA. So from this data set, we selected countries based on the size of their networks in 2019 and took only the countries with more than 100 investors so that we could get a kind of robust statistical analysis. Unfortunately, that meant that we had to exclude China from our analysis because there's a large amount of unknown investors reported in the data set, which makes it hard to analyze. So our final 10 set of countries, which are highlighted in yellow, include countries that have led the technological development of wind, like the UK and Germany, as well as two emerging economies in Brazil and India. And together, these 10 countries represent almost half of global installed capacity. So first, we look at the composition of the investor networks. And we did this by categorizing the investors into 8 different types of financial actor. And these pie charts show the composition of the equity part of the network on the left and the debt part of the network on the right. And what you can see is that energy companies, who are typically the project developers, are the largest category of equity investor, while banks are dominating the debt market. However, we also see that there are interesting differences in composition between countries. So for example, in the UK and the US, over 80% of banks in the debt market are privately owned, whereas in the Indian debt market, private and state-owned banks are equally represented. So we see that the composition of the networks are reflecting broader characteristics of the financial systems of these countries. So the public sector plays a much more influential role in India's financial system compared to the US and UK, who began liberalizing their banking sectors decades earlier. So next we move on to the network structure. So the most important information on a network structure is given by the degree distribution, which tells us the distribution of co-investments between investors. And because these networks are bipartite, there are 2 degree distributions, one for the equity nodes, which is shown in yellow, and one for the debt nodes in blue. And what we see is that far from the co-investments in the networks being distributed randomly across investors, most investors make only a few investments, while a few investors make many investments. And this is quite typical of social networks. It indicates the presence of what we call network hubs. And these are these are nodes with investments that exceed the average number by 1 standard deviation. And the dotted lines in these plots are indicating where the average degree is. So they're typical of social networks because certain nodes often become more popular or visible for a particular reason, and over time become highly connected. And the growth of hubs can therefore be used as a signature of the way in which a network has evolved. And the hub activity becomes kind of characteristic of the network dynamics. So our next step was to explore the relationship between the composition of the networks and their dynamics. So we know that public and private actors play distinct roles in renewable energy finance markets. So we aggregated our 8 investor categories along this key dimension, public versus private. Then to characterize network dynamics, we used the activity of the hubs, which we saw were a key structural feature of the networks. We defined a metric called hub activity, which is the number of co-investments made by hubs in a given period as a percentage of the total number of investments. And in the following analysis, we're going to focus just on the period between 2015 and 2019, which we take to represent a relatively stable outlook for wind markets, given that by this time, global economies had recovered from the financial crash of 2008, and the socio-political changes brought in by the Paris Agreement had begun to come into force. And in addition to this, since wind markets were at a relatively mature stage by this time, the flows of investment were high enough for us to obtain robust statistics with our network analysis. So here we've plotted the private share of investors against hub activity for both the debt and equity parts of the network. And we see that there's not much correlation in the equity part, which I'll come back to later, but in the debt part of the network, there's this positive correlation between the level of private participation and hub activity. So for example, if we take the US, Canada, and the UK, in which private participation is above 85%, we see these distinct network dynamics in which a small subset of debt hub investors, who represent only 10 to 14% of the network, are undertaking more than 40% of all new co-investments. So investment activity is being concentrated in this small set of investors. And the high levels of private debt investors in these countries is likely reflecting a low-risk investment environment that's being created through effective use of price-based policy mechanisms, such as contracts awarded through auctions in the UK and Canada, and production tax credits, which are used in the US. Conversely, in debt markets where public institutions play a greater role, these dynamics appear to be suppressed. So in the Indian debt market, for example, which has the lowest level of private participation and the lowest levels of debt hub activity, the activity is dispersed across the network, with hubs accounting for just 17% of investments. And the greater role for the public sector in India is likely reflecting a more challenging investment environment for the private sector. So unlike in debt markets, as I mentioned earlier, the equity hub activity appears to be insensitive to the public-private composition of the network. The private participation in the equity markets is consistently high, which is reflecting the liberalized models of electricity generation in all of these countries, but the equity hub activity is ranging widely among the countries. So this suggests that equity market dynamics may be interacting with a more complex set of country-specific factors. And in the rest of this presentation, we will focus on the dynamics of debt markets only, and acknowledge that a deeper analysis of the equity market dynamics is going to be a very interesting avenue for future work. So the sensitivity of the debt hub dynamics to investor composition and the broader market environment suggests that debt hubs play a critical role in the investment ecosystem. So we then wanted to further characterize the activity of debt hubs, and we did this using the Herfindahl-Hirschman index. And this index is conventionally used to capture the level of competition in an industry by looking at the spread in market share of organizations. And here we use the number of co-investments made by an investor as a proxy to market share. And what we see is that, with the exception of Brazil, there's a strong negative correlation between the level of hub activity and the HHI score. And this suggests that when hub investors play a significant role in a network, they tend to emerge in larger groups that are competing together for projects. So as an example, this table shows the hubs that were active in the UK debt market between 2018 and 19. There are 13 hubs, and the top 5 all have similar investment levels, which is shown by the closeness of their S scores. And it's also interesting to note that the 2 top hubs are Japanese private banks. And it's been noticed that this trend has emerged because there have been prolonged low interest rates in the Japanese market, which has driven them to invest in European markets. So the attractiveness of the UK market to foreign investors supports the idea that the low HHI index score that we see suggests that the lenders in this market are competing for projects. By contrast, in India, where there's much lower hub activity, we see it occur alongside a much higher HHI score. And this is capturing the fact that only 5 hubs are active between 2015 and 19. And the 2 public banks, IIGF and the Asian Development Bank, are taking the major market share. And they're providing finance on a mission-oriented rather than profit-seeking basis, which also supports this idea that there are low levels of competition in the debt markets with a low HHI score. So Brazil is the outlier that I mentioned earlier. It shows very high levels of hub activity, but also has a very high hub HHI. And this can be explained by some unique characteristics of Brazil's wind market. So it's had very successful growth, but it's depended very heavily from the outset on concessional debt finance from the Brazilian Development Bank, BNDES, due to the fact that private finance in the private finance in Brazil is prohibitively expensive. So in the final step of this exploratory analysis, we looked at the relationship between the growth of wind markets and their network dynamics. So to capture the growth of the market, we used the average annual increase in installed wind capacity. And what we observe is that the fastest growing markets typically show high levels of hub activity. So with the exception of India, in all the markets that increase their capacity by above the average annual rate of 10%, which is shown in the plot, and these are the countries of Australia, Brazil, the UK, and the US, debt investor hubs are financing more than 40% of all of the investments. In contrast to this, India's fast capacity growth of 12% per year is observed alongside low levels of debt hub activity, which we earlier linked to the low levels of private participation in the Indian debt market. And this can be explained by India's distinct growth. So in India, there have been significant capacity additions from small and medium-sized enterprises, for example, in the textile industry. And these firms build small wind farms with the help of capital subsidies from regional governments and state banks. So growth in India hasn't relied on the private debt market, which explains why we see its low debt hub activity alongside fast growth. So to summarize this first part of my talk, in highly privatized debt markets, which we saw are typical of economies with liberalized financial sectors and low-risk investment environments, we observe distinct network dynamics in which investment activity is concentrated within a small group of hub investors. And the investor hubs in these highly privatized debt markets are typically commercial banks, both domestic and international, and their activity suggests that they're lending in a competitive environment. We then saw that in the fastest growing markets, with access to private debt, the hubs support growth by financing at least 40% of investment activity. But we saw that there were interesting counter cases in the emerging economies of Brazil and India, which had different pathways to growth. So in India, growth has been achieved through government subsidies for small businesses without recourse to private debt, while Brazil financed its large amounts of growth through its one national development bank. So finally, to explore the connection between high debt hub activity and fast market growth, we developed a quantitative model of network evolution to describe investor behavior and the formation of debt hubs. So to focus on the growth of debt hubs, we modeled the co-investments made between new equity investors entering the market and existing debt investors. Given that we know there are barriers to entry for new investors in renewable energy markets, so for example, a lack of confidence and a lack of experience, we tested a preferential attachment model of network evolution, which is also known as the rich get richer model. And what happens in this model is that the likelihood of a new investor entering the market and choosing a given debt investor to invest with increases as a log linear function of the number of the debt investors' prior investments. So this captures their level of experience. And the beta exponent represents the strength of preferential attachment. So in the linear case, which is plotted on this slide, when beta is equal to 1, doubling the number of investments that you have as a debt investor doubles the probability that you'll make a new investment. So what we found is that this PA model well describes 6 out of the 10 countries analysed, including the key fast-growing markets of Australia, Brazil, the UK, and the US. And unfortunately, in the remaining countries, there wasn't enough data to do a rigorous model validation. So what I've plotted here is the estimated beta exponent against the average growth rate. And we observe that there's a trend towards higher beta values in the fastest growing markets. And this provides us with a mechanistic explanation for why these fast growing markets also show high debt hub activity, because higher values of beta indicate that when a new equity investor enters the market, they have a stronger preference to invest with a debt hub. And it's important to say that while there are other attributes of debt hubs, as well as their experience, which are not included in our model, that might be important, for example, the size of their business and the type of their business, past investment experience does appear to be a major driver of investor behavior and network evolution. So the process of financial learning is an intuitive interpretation of preferential attachment in the context of wind markets. So as a debt investor makes more co-investments, they build a track record and accumulate data and experience on past projects. This allows them to make more accurate risk assessments of new projects and therefore reduces their required safety margins on loans. So experienced investors are likely more able to offer new equity partners loans on better terms. So financial learning has actually already been identified in renewable finance markets, but what we do here is we provide evidence for the effect that financial learning has on the structure of investment networks, which is the creation of these debt hubs and the concentration of investment activity within the subset of debt hubs. So furthermore, we can draw a link between the strong preferential attachment that we see in the fast-growing networks and fast rates of financial learning. So we speculate that fast rates of financial learning in debt markets, which quickly bring down the cost of debt finance for investors, both reflect and engender confidence in the market. And this in turn attracts new equity investors into the market, triggering a virtuous cycle of investment and boosting capacity growth. So the role of debt investor hubs in fast-growing markets goes beyond simply providing finance. What these results suggest altogether is that through the feedback effect of financial learning, the debt investor hubs themselves are stimulating network growth. So to summarize these results, what we've seen is that in developed economies with mature private finance sectors, fast growth is associated with a group of debt investor hubs who perform several critical functions. They support investment activity by collectively undertaking at least 40% of new co-investments, and they're also at the forefront of this financial learning process, which signals confidence to the market and thereby stimulates growth. From a policy standpoint, it's significant that most of the private debt investors hubs in the fast-growing wind markets are commercial banks, which suggests that strategic intervention to boost growth should encourage the private banking sector to step into these critical hub positions. And that could be, for example, through risk mitigating debt instruments. In addition, the positive feedback that we have put forward between financial learning and growth of the market suggests that we should be encouraging knowledge spillover, especially at an international level, from mature to less mature renewables markets. And this would facilitate the growth of debt hubs. I've also showed that we identified different pathways to growth in the two emerging economies, Brazil and India, where fast growth was achieved through stronger interactions with the public sector rather than private debt markets. So our study demonstrates the relevance of the complex system approach to understanding wind markets and the behavior of heterogeneous wind investors in different settings. And we hope that this analytical framework could serve as a useful starting point for more realistic models of renewable finance markets more generally, and perhaps could be applicable to markets that have seen similar technological and deployment trajectories to wind, such as solar. So thank you very much for listening, and I look forward to your questions.
Thank you, Jimmy, for your enlightening presentation. Now we still have 6 minutes for the questions. Let's look at the question 1. Why does the market composition and the debt to equity funding decomposition matter for wind energy in specifics?
So I'm sorry, can you repeat the question? Why does the debt market composition?
Why does the market composition matter for the wind energy in specific? So why you choose to study this specifically for the wind energy, not for solar or any other renewables or non-renewables?
So, I mean, we're interested in all different technologies, wind and solar and hydro. As a team, we've been looking at all these technologies, but we focus on one at a time because we think that the characteristics of these technologies and the characteristics of the investor networks and investor ecosystems behind them will be distinct. So in order to analyze them, we have to take each technology separately. So in a sense, this framework could equally well be applied to solar, and it'd be interesting to do so. But in this case, we focused on wind. So it's actually part of another project to look at to apply the same analysis to solar markets. Since solar and wind are kind of the two fastest growing and most important technologies for the energy transition. But yeah, this paper we focused on wind.
Yeah, do you expect it that like solar energies or any other renewable energy actually will have the similar type of investor behavior? Or
I mean, that's a really like interesting avenue that we're exploring. So obviously the kind of the financing characteristics of wind assets is unique to solar in some ways, in the sense that the upfront capital costs are much higher, which requires larger investments from typically like large commercial banks. And the same is necessarily true of solar, where you can see much more kind of decentralized investment made by smaller enterprises. So there could be some interesting differences in the structure of these networks that relate to kind of the financing characteristics of the assets.
okay, thank you. So we still have 3 minutes. Now I have a question for you. So how do you really define the debt investor and equity investors during the whole study period from 2000 to 2019? For my understanding, an institutional investor could be a debt investor at one point in time and an equity investor at another point or for another project. So, or you found the investor tend to stick with their previous investment strategy. I found that interesting. How do you define it?
Yeah, it's a very interesting aspect of the data. So in the data, actually, the investors are entered as providing equity or debt. So you do know which type of finance they provided, but you do see a small subsection of the investors who appear in different projects as providing either equity or debt, and these are usually the institutional investors, exactly. So what we did in the analysis was just to treat them as if so the small subset, and there was like I think only about 5% of the investors, if they did enter a transaction as both equity and debt investors, we separate them out and treat them as individual notes.
Okay, thank you. I can't see any other question. Let's move on to the next presentation. Our next speaker is Dr. Liang from Singapore Management University. He will be presenting outsourcing climate change.
Okay, thank you, Xiaoyan, and thanks for the organizers for accepting this paper, and I hope everybody can see my slides. This is a joint work with Rickman from Water Research Data Services, Duan from Vienna University of Economics and Business, and Lilian from York University. So let me briefly motivate our research by highlighting this graph, which was from a blog that I contribute to PRI, showing the global greenhouse gas emissions per region or per country. So as you can see, the blue colors represents carbon emissions by developed economies, Japan, EU, and United States from 1990s to 2018, and you see a roughly flat and even declining trend. When you look at the orange color, which represents emissions by emerging economies, China, India, Russia, Brazil, then you see upward trend. So over time, the emissions increase a lot, especially by China. So if we take these results at the face value, it seems to suggest that carbon emissions or global warming is largely due to emissions by emerging economies, but we know as researchers, we don't take results at the face value. We aim to take a deeper look into this question. This is a big question because it draws a lot of attention globally. We know that Paris Agreement is about holding the increase in the global average temperature to be well below 2 degrees Celsius, about the pre-industrial level. That was drafted by Brazil, South Africa, India, China, and the United States in 2015. And shortly after that, during the G20 summit in Hangzhou, the key theme of the summit was green finance. So that basically ratified that finance plays a big role in combating climate change. But of course, we know that it's not always forward moving. Sometimes we also move backward. For example, shortly after the G20 summit, Donald Trump was elected as the president of the United States, and he announced to withdraw from Paris Agreement. And early this year, another president was elected, Joe Biden. A few hours after he officially became the president, he announced that US would return to Paris Agreement. So there seems to be a lot of back and forth. And on investor side, according to a recent paper published on Review of Financial Studies, in which the authors sent out surveys to large institutional investors around the world, and one survey question was about which approach that they took in the past 5 years to incorporate climate risk management in their investment process. And majority of the investors consider analyzing carbon footprint of their portfolio companies to be the most significant climate risk. Okay, so given all this anecdotal evidence highlighting the importance of climate change, we try to focus on firm behavior because despite a lot of government efforts through laws, regulations, taxations, corporations play an important, probably even more important, than proactive role in reducing greenhouse gas emission. For example, Microsoft has been carbon neutral since 2012. Amazon is targeting a net zero carbon footprint by 2040. And a few large corporations are committing to have 100% renewable electricity, so the so-called RE100. This is also an effort to combat climate change. Okay, in many countries and states, regulations are very strong in curbing corporate emissions. For example, in California, they have the carbon trading system, which is called Carbon Trade Program. And in a recent research by Bertrand, Ho, and Kim, they found that some financially constrained firms, they may shift their emissions and plans to less regulated countries and states to evade regulatory constraint or regulatory cost. So from these studies, what we observe is that much of the attention has been paid to a company's direct emission, as so-called Scope 1 emission. So that's the emission from the company's own operations, and also Scope 2 emission, which is the emission from the energy consumption during the production process. However, existing studies largely overlook the indirect emissions from the company's supply chain, which is so-called Scope 3 emissions. And Scope 3 emissions, according to many scientists, is actually a much larger part of the overall emissions. Let me illustrate Scope 1, 2, 3 with this graph. So Scope 1, as you can see, they are the emissions from the owned and controlled sources by the corporation. And Scope 2 refers to energy consumption or the purchased energy. So if I make production, I also consume electricity, then the emission from that will be Scope 2. Scope 3 are the emissions which are indirect and that occur on the firm's supply chain or value chain. And that can be upstream, so that means those are the emissions from the firm's suppliers, or those can be downstream. So those are the emissions generated by the company's customers. Although they are not directly generated by the company in focus, But then because of the company's business operation, then their customers and suppliers also have to make products or provide raw resources, which leads to emissions. So a case in point is PMG, one of the largest consumer goods manufacturer in the world. PMG has a very ambitious climate commitment, which is to reduce its annual emission by 50% by 2030. That's a huge commitment. So if you think about PMG's production, then most of the emission that's directly created by PMG is probably tissue products, right? However, in order to make those tissue products, they need to log forest, they need to resort to pulp mill, and those tissue products will also go to toilet. And all these customers and suppliers, they also create their emissions. So if you look at the scope 1 and scope 2 emissions, so that's the emission from this part, they only account for less than 5% of the total emission by PMG, whereas the supply chain emissions account for more than 90% of PMG, but that is largely overlooked. So when PMG claim that they want to have a 50% reduction in annual emission, that's only about the small part. That's only about scope 1 and scope 2, not really about scope 3. Another anecdotal evidence is Britain as a country. So Britain being one of the most progressive countries in combating climate change, if you look at their overall emissions at the country level, over the last few decades, you see a clear downward trend, right? So it seems to suggest that British firms are doing pretty well in terms of curbing greenhouse gas emission. However, this line represents emission from production without imports. So that is without suppliers' emissions from overseas. If you take into account of imports, so those are the emissions that actually happen in their suppliers overseas, you don't see a downward trend. You actually see an upward trend. So that suggests that actually UK as a whole is not really reducing the overall emission. And considering it is one of the most progressive countries in this effort, if you look at a global scale, I think the picture is not that bright. So in fact, despite all these regulations and efforts, we may not expect to see that the overall emissions actually reduce globally. So this comes to our research questions. We have several research questions. First, do firms shift their own emissions, which is scope 1, and their supplier generated emissions, which is scope 3, and when we talk about supplier, that's upstream scope 3, around as a response to their domestic regulatory pressures, which result in a so-called emission offshoring. And if such emission offshoring occurs, what are the mechanisms? Third, do firms develop more green innovations to offset emission outsourcing? And finally, are investors aware of the potential risk of such emission outsourcing and probably price it in the stock market? So these are the questions we are going after. Let me briefly talk about the data. So given this is a sustainable finance conference, probably the audience are already familiar with some of the databases that we use, including S&P True Cost, which collect firm-level environmental data, including their disclosure on greenhouse gas emissions, water use, pollution impacts, and water disposal. They use a lot of publicly disclosed sources from different countries, and they compare the data scope 1, 2, 3 at the firm level. And we also look at imports, because as I showed you earlier in the UK chart, a hidden emission is actually happening on the upstream supply chain, which occurs overseas. So that's represented by imports. So in order to capture the import part, we use a database called Panjiva, which collect data on import and export details on commercial shipments around the world. So they have ocean freight shipment data for imports and exports from the US, including container specifications, TOE, weight in kilograms, and metric tons. We also have a few firm-level ESG ratings, including Refinitiv, as well as Rep Risk, which captures ESG reputational risk. Probably Panjiva data is a bit new because it's about import. It's not really about ESG. So let me talk a little bit about Panjiva by giving you this example. It's a US firm, Tesla. So Tesla imports from suppliers in different countries. If you think about the Tata Group, Tata Auto Camp, that is in India. So Tata is one of the suppliers to Tesla. This recorded in Panjiva database. And of course, Tata also supplies to other companies in the US. And then Tesla also import from other countries, suppliers in other countries. And in Panjiva database, you can also see, who are the suppliers. So for example, Shenzhen Qiyuan Technology from China. What's the volume of their imports in TUE? What's the weight? And what's the value of the goods in the shipment? And what kind of industries those goods actually represent. So HS codes represent industries. So we have detailed information on per shipment import value, number of shipments, and we can actually use this information to help us calculate how much emission actually is attributed to overseas suppliers. We have other data sources. I'm going to skip for the sake of time, and let me directly show the regression equations we have. So we have two sets of regression equations. The first one, we have scope 3 as the dependent variable and scope 1 as the independent variable together with controls and fixed effects. So this basically measures the relationship between scope 1 and scope 3. Scope 1 is measured as the logarithm of 1 plus scope 1 emission in tons divided by total assets. So it's an intensity measure. Or we have an alternative measure, which is the percentage of total scope 1 emission over the total emissions, scope 1, 2, 3 altogether. We do the same for scope 3, and one note I want to make is that here, when I refer to scope 3, according to our data, it's only upstream scope 3. It's not about customers. It's only about suppliers. And then the next regression we have is we interact which is
Sorry for the bad internet signal.
Can you still hear me?
Yeah, we can hear you now.
Okay, can you see my slides?
Yeah, now it's getting back to normal. Can you continue?
Okay,
Thanks.
yeah, so for whatever reason, you couldn't hear me, but let me continue.
Yeah,
So
thanks.
if you look at the proportion of scope 1 and the scope 3, they are negatively correlated. So that suggests as a firm decrease its scope 1 relative to overall emission, then its scope 3 actually increase, okay? And next, if we look at the interaction term, as I showed you earlier, the interaction term are all negative. So that means the scope 1, scope 3 connection, if you think about the overall emission, then they are attenuated by the imports. If you think about the proportion, which is negatively correlated, this is even amplified by imports. So both indicate that imports actually allow firm to outsource more from overseas. Okay, so these are our baseline results, and we are mindful of identification of endogeneity problem. For example, firms may choose countries of imports for other production cost consideration rather than their carbon emissions. So what we do is we explore shocks on the incentives for US firms to outsource their carbon emissions. We identify two types of shocks. One is domestic legislative pressure. The other is regulatory stringency. So how do we measure legislative pressure? We calculate the average voting score across Congress members on environmental legislation separately across the Senate and the House of Representatives in each state. And we then identify state years that experience score increase by more than 3 times the average increase during our sample period. So we consider 3 times increase as a sudden shock. Second, we also identify the so-called close call Congress elections in the spirit of a regression discontinuity. Those elections are about environmentally conscious candidates who won the election, and then we aggregate the state years with positive net close win count for those candidates. In terms of regulatory stringency, we identify whether a state has enacted greenhouse gas emission targets. We also identify facility level inspection intensity by environmental protection agencies increased by more than 3 times the average increase in the sample period. So these are kind of unexpected shocks to a local firm. So because our baseline analysis is already a triple interaction, so if we add a shock, that's a triple, our baseline was double interaction, and if we add a shock, that's a triple interaction, okay? And here are our results. When we interact with the treatment, either these are legislative shocks or these are increase in regulatory stringency, we see that this offshoring or outsourcing effect to be even more negative. So that means the outsourcing effect is even getting stronger. Okay, so this is a Congress vote score increased by 3 times. These two are close call elections. We look at Green Democrats, or we look at the candidates' overall voting score based on their past voting record. And so basically that confirms our baseline results. With that, we have done a lot of other robustness tests, but for the sake of time, I don't have, I'm not going to read all of them, but I just summarize them here. We find the outsourcing effects are stronger for US firms from industries with greater emission intensity, for their suppliers from countries with less stringent environmental regulations, and we identify a few internal mechanisms. For example, if the firm has a high ESG rating, they probably care more about their reputation, right? Or if the CEO worked in the past in green firms, in firms with high ESG ratings, they also care more about their personal reputation. Same for directors. So we call them green firms, green CEOs, green directors. And we find they intensify the outsourcing effect. We also look at a few external mechanisms. For example, if a firm does not have a government customer, the government may usually care more about the overall environmental externality, so they may curb this outsourcing behavior. or corporate customers, which usually span across different countries, they may also curb such outsourcing behavior, or institutional investors who hold their portfolio across the world, who may also care more about the global carbon footprint rather than just within US. So then the outsourcing effects will be attenuated. The outsourcing effects will be stronger when the firm does not have such important stakeholders. We also look at economic consequence in terms of whether outsourcing firms have more green innovation. We look at whether outsourcing firms have greater reputational risk. We also look at whether investors price in such climate risk, especially hidden in their imports. Just quickly show you the results. When we run a regression of green innovation on our outsourcing measures and the emission measures, especially this imported CO2, we use the Panjiva data combined with input-output analysis to roughly calculate what's the carbon footprint for each shipment. That's our imported CO2 measure. We find this to be negatively correlated with green innovation. So this measure, if you like, they represent outsourcing. So outsourcing firms, the firms that outsource more emissions, they are not more innovative firms. They are less innovative firms. So they both outsource, they also shirk their responsibility in terms of developing new technology. Are investors aware of that? Investors, so such firms, they have higher reputational risk, and investors are not aware of that. So that's why this outsourcing risk is not fully priced in their stock market. So especially if we look at scope 1, that's already priced in, so you don't see any predictive power. But if you look at scope 3 or you look at imported CO2, they are not priced. So that means investors are not fully aware. So they still have predictive power. So to conclude, despite all these efforts we have been talking about, companies, they have strong incentive to evade their responsibility. So this results in a whack-a-mole game. And we find strong evidence that US firms reduce their carbon footprints through outsourcing pollutions overseas. And such emission outsourcing is not fully priced by the investors, and those other firms actually have less green innovation. So the implication is that it's important to count carbon footprints along the whole supply chain. And we also try to think about some policy implications. But I think one important implication is that we need more international cooperation to achieve global carbon neutrality. So it's not a single country's problem. So thank you very much for your attention, and I'm open to more questions.
Thank you, Dr. Liang. Obviously this is a very important question to address to achieve net zero carbon emission globally. Let's see if we have any questions from the audience. Yeah, while we're waiting for the questions, I have a question for you, maybe two. So because the carbon emission or carbon outsourcing vary greatly across sectors, like for example, like electricity, heat, transport accounts for like the majority of total carbon emissions for almost all countries. I think you didn't present, or it would be more informative to show like what the carbon intensive industries included in your sample, and how many sample firms in each of those sectors. The question why I'm interested in this, because for example, take the example of the electricity generation sector, obviously it will generate more carbon emission from burning coal or other fossil fuel to generate power, other than you import coal or fossil fuel from the sources or the coal mining. that and also another example is that for healthcare industry, it really so for many different sector identification, healthcare technology, they actually emit very low carbon emissions domestically. But for example, their equipment or production equipment or the material of the equipment might actually generate more carbon emission. That's why I'm asking, do you have any like figures or tables to present this information? Like specific factors, which are those factors are carbon incentive in your sample, and how many firms in each sector?
Yeah, so the short answer is we don't have this analysis currently in our draft. What we did is just look at those firms in high emitting industries versus low emitting industries. But we have different industry classification methods, but we were not that specific on which industry and how many firms or how many observations we have in each industry in our sample. So this is something I think we can do in the next stage. What we are also thinking about to strengthen this argument is to look at the relative position in the value chain. For example, you mentioned about healthcare industry, and you also mentioned about the electricity industry, right? So I think their relative position in the value chain are so different. So maybe the more upstream you are in the value chain, for example, electricity or oil and gas, I would consider them to be more upstream. Then maybe this is something because you don't have that many suppliers, right? Whereas healthcare, or if you are more downstream, you are closer to your consumers, you care more about your image, and you also have more suppliers or several layers of suppliers. We would expect such outsourcing behavior to be stronger for industries that are more downstream. This is something we have in mind, but we haven't formally tested. I think this is a good suggestion.
Okay, thank you. Just one last maybe or suggestion. For exactly the same reason, I think it's important to add like the sector fixed effect in the model, because I can't say maybe I neglected. If I should add this sector specific fixed effect in all the regression. It will produce more reliable.
Yeah, so I think we have country, year, and industry fixed effect. We don't have industry times year. We have country times year, but we do control for industry fixed effects. Yeah, but I think this is important. This is crucial.
Okay, thank you, Dr. Liang. Thanks. Okay, let's see if we have any other question. Yeah, we got a question. So I'm curious whether you analyze separately firms that claim to have a sustainable supply chain and how they differ from firms that disregarded their supply chain practices.
Okay, I think I'm not quite sure I understand this question correctly, but I think it's about whether a firm claims they have a sustainable supply chain, right? So I think firms like Amazon, basically most of their emissions are actually from their suppliers rather than from the company itself, or many platform economies. So those companies, they tend to claim they have a sustainable supply chain. I think one major constraint is whether we have data. I'm not quite sure. So if there's any suggestion on, how can we classify firms with sustainable supply chain and firms that discard their supply chain practice, that will be very helpful.
Okay, thank you. Let's probably move on to our last speaker. So our third speaker is Dr. Nadia Ameli from University College London. She will be presenting the climate investment trap in developing economies.
Thanks a lot for the presentation, and thanks everyone for attending our section. As mentioned in my analysis, this analysis is about the cost of finance and the links between investment and developing countries. we did this work as a joint analysis between UCL Institute for Sustainable Resources and UCL Energy Institute. And you can see here all my co-authors. It was quite an important study which involved almost 10 scholars. The main reason really, I would like to provide a little bit of context for our research. The main reason why we try to basically analyze investment flows in developing countries, it's because the capacity to mobilize funding is really linked to the local enabling condition. I mean, if we look at the macro trend, the macro data about sustainable finance, we do see that most of capital are mobilized within developing countries. And just a little fraction goes to the developing economies. And that's because really investments, they are really affected by the macroeconomic condition, the business confidence, the regulatory framework, the technical change, and all those factors are quite context specific and differ quite a lot among countries, especially developing economies and developed ones. And the main result is basically all those factors are reflected in investors' perceived investment risk. And so at the end of really the analysis, investors do perceive much riskier countries like Africa or Asia, some countries in Asia, rather than, for instance, Europe or United States or China. So we try really to capture those kind of differences and investment condition. And what we use was as a proxy is the WACC. WACC stands for the weighted average cost of capital. So that means we try to understand what's the effect of the cost of capital as an average of the cost of debt and the cost of equity. And we try to do this because in most of the decarbonization pathway exercise, the cost of capital is not taken into account. And I'm really referring also to this macro modeling exercise and scenarios, for instance, coming from the International Energy Agency. What basically those scenarios do is really to use a uniform cost of capital that usually is in the order of 8 or 10% or another rate, which means really to use one value that somehow really summarize this financing cost or other hurdles that to make investment happen. But actually, really, what we want to push and we show with this analysis is actually that assumptions about the cost of capital are really crucial in modeling decarbonization pathways. And in this study, really, we try to see how basically decarbonization pathway may differ when financing conditions are represented and explored. So what happens if we try to take into account the real cost of capital in Africa rather than a kind of general cost, uniform cost of capital that is used for Africa as for Europe. We also, in this analysis, we also try to introduce a new concept and we theorize a new idea that here we call as a climate investment trap. And it builds a little bit on the concept of the poverty trap. The poverty trap, for those who are not familiar, is a concept that really says or suggests that it's much more difficult for a country which is already in a poverty condition to escape this basically the poverty. And what we believe that it's a similar mechanism may apply for climate investments. So basically, climate investment trap occurs when climate-related investments they do remain very low over time. And that's because there is a set of self-reinforcing mechanisms that keep those investment levels really low. And here is the sort of set of mechanisms that we see. If we think about developing economies, the cost of capital is already higher compared to the developed ones. That really lead to low climate investments. And that means that the climate effects, the climate impacts are much worse in those economies, in those markets, which will further basically increase the risk of investment in those countries, will lead to high risk premium. And again, it feeds back to the initial cost of capital level. And that's what we think it might happen, or is already happening in developing countries, or at least in some really risky countries, like for instance, Congo, rather than other regions. What we do in this analysis is to try to, as I say, to model those different financing conditions across countries. The method that we use is the TM-UCL model. TIAM belongs to the family of the Times Integrated Assessment Model, and is the version for UK developed by the UCL Energy Institute. As you might be aware, the Times model are bottom-up technology-led models where the model tries to optimize the energy mix based on the cost of the technology. So given the sort of parameters that we set or the climate targets that we set, the model really defined the energy mix in order to reduce, to basically to find the optimal mix based on the technology cost. It is a global model, despite there are some simplification that you can see on the corner in the map, where we represent basically the world in 60 regions, where there is more detail on some countries. For instance, UK is represented as a single country. Rather, for instance, Asia, you see it's basically one region, and the same applies, for instance, to Africa or South America. In this context, there is a climate model, and there is basically an input that summarized the cost of capital. And what we did in this exercise was to change this cost of capital assumption and differentiate the value across countries. And that's really the novelty of this analysis. We collect a new data set on the cost of capital, and we try to play with those values. Here you see the representation of the cost of values that have been used in our analysis. The brown bubbles represent basically the cost of capital for fossil fuel assets. The green one, the cost of capital for renewables. And the gray is the optimal cost if we consider some policy intervention that brings down the cost of capital, that I'm going to explain in a while, is a new set of scenarios that we try to model in this analysis. It's important to say that the cost of capital that we use and we collect in this analysis is built on the corporate finance idea, on the corporate finance assumption, sorry. That means we consider the cost of capital that a company in the given sector will pay in order to raise capital. While there are other costs of capital, can be, for instance, the project finance, which is more the cost of finance that you can access for a specific project. Something that I would like to stress quite importantly, in doing this exercise where we collect the cost of capital, the main factor driving those differences across countries is really the country risk premium associated to the high and low carbon investments. And now let's talk a little bit about the scenarios that we implement in our model. In our model, we implemented two sets of scenarios. The first set of scenarios that we call regional and global, it's basically a comparison among a scenario that applies a uniform cost of capital that you can see in the global scenario. So it's 5.9 for low carbon assets and 5.1 for high carbon. And then a regional scenario where we implement those cost of capital that relates to the single countries or geographical area. In the second set of scenario, we then we take a further step forward where we try to understand some effects that can happen or we can see in case we would introduce some policy that would reduce the cost of capital to an optimal level. And we assume basically two time frame, and here we say the fast scenarios and the slow scenario, where this basically reduction in the cost of capital happens by 2050, or it happens by the end of the century. And here it's really a very simplified chart to show the sort of trend of the cost of capital, for instance, for developing countries, and here it's the image for Africa. So you see the green dot is the current cost of capital that we compute for Africa, while, for instance, the global scenario, the red dot shows the usual cost, the uniform cost that is applied. And then you see the other scenarios to give an indication how the cost of capital will be reduced or is being used. Now let's move to the results. As I said, the first set of scenario is really a comparison between the global versus the regional WACC. And in this speech, I'm going to present basically a case from the developing world and a case from the developing, the developed markets. So we pick Africa and Western Europe. We do have results available for all regions. And I have to say that they're really aligned to those that here we picked. And we can observe that there is quite a large effects in Africa, while there are not really real impact in Western Europe. And that's because really, when we consider the real cost of capital in Africa, that means it's almost double the cost of the capital compared to the uniform scenario. So it's about 12% against almost 6% on the cost of capital. And this has really implication in terms of the electricity generation that you can achieve, or you can have in Africa. In the global scenario, so when you have this uniform cost of capital, you get much more electricity. So we estimate it's in the order of 35% more by 2050. And this also translates in a lower emission, so in about 20% emission by 2050. And the striking also results is basically you get those very different results for the similar level of investments, which is $80 billion. So you do see this kind of huge difference that, that basically appears in the results when you implement the real cost of capital. And these first results already suggest us that when the real cost of capital is implemented, the low carbon transition, it's much more expensive in developing economies that we normally expect from the standard exercise or scenarios that we are currently modeling. We don't see actually any real impact in Europe because the difference between the cost of capital, it's basically very close. So you can see the two lines almost overlaps. So there is not really critical results to stress, I would say. Then that's the second set of results. It's when we consider basically these two different scenarios where there is the fast and the slow scenario, and it's really about the impact of WACC reduction policies. Here we don't focus on a specific policy, so we don't theorize which one can be the policy. It can be anything that goes between guarantee schemes or concessional finance or any other policies that can be in place. What we are interested in this exercise is really more to try to understand, to estimate what will be the impact of reducing the cost of capital to an optimal level, and what will be the impact if we do this in the next 30 years rather than the end of the century. And again, we can observe very large effects in Africa. So low carbon electricity is much higher in the fast scenarios and also in the slow scenarios, we get more electricity compared to the reg scenarios. So in the fast scenario, we got about more than 40% electricity generation, while in the slow scenario, it's about 6%. This also translates in more investments, which will require more investment to achieve those targets. Again, we don't see any huge differences when it comes to Europe, because again, there is really, the cost of capital is already somehow low and close to the kind of the optimal level. Another important result that we can see in our analysis is about the impacts on emissions. Because of course, in the fast scenario, you're able to deploy more electricity generation, low carbon electricity generation, you're going to reduce emission much faster. And the strong results is that Africa could achieve net zero 10 years earlier if we speed up the reduction of the cost of capital, which is quite an important result because, you know, we are talking about results over the century. And that's really, I think, one of the most important key results of our analysis. Again, not huge impacts on Europe, because as I said before, there is not a huge difference. So we are going to have more or less the same level of deployment of low carbon electricity, which doesn't basically translates in any strong reduction in terms of emission. Just some policy implications, just if we try to make an effort, if you think about the relevance of those results in the current basically policy debate. Here basically just some thoughts, some final thoughts. I think we really try to understand the meaning of the results in comparison how basically we can mobilize capital in developing countries and what are the links between financial markets and investments in developing countries. And of course, we can see three channels. There is the private capital markets. And what we see in terms of happening in finance now, most really of the sustainable finance framework that we see, and most of the finance and the capital flows that we see are just happening in the developed world, and the sustainable finance framework are designed for the developed world. There is a strong focus on low carbon assets, and there is no focus at all on the country dimension. So we really should make an effort in terms of policy recommendation, policy design to target specific country if we want the capital goes there. Because I mean, one of the biggest challenge today is really to mobilize capital in developing countries. There is this wrong assumption because, for instance, Africa is a country rich of sun, investment will happen. Actually, this is not the case because as we show, the cost of capital is quite high. And actually, we even show an average for the continent. But if you take specific region like Zimbabwe, Congo, the cost of capital can reach really 30%. So it's very hard to mobilize capital, especially private capital, international private capital in those regions. Then the second channel through which investment can flow in developing economies, it could be definitely the public and development finance. Those institutions are really crucial and critical in creating and providing this initial capital or in helping the access of low-cost capital. Another really action that should focus is to foster the local markets. For instance, the green bond markets is seen as a promising really way to creating some financial markets in developing economies. And the last entrance in the debate are for sure the central banks and the financial regulation. I think we have seen a different role of central banks across markets, where developing countries are embracing a little bit more the idea of including climate goals within the mandate of the central banks, while European countries, but even US, so developed economies, they are stick to the kind of the mandate of the central banks, which is around inflation rather than really targeting climate targets. But again, those institutions and especially financial regulation can be used to lower the cost of capital and likely to underwriting risks. So that could be really a way to somehow overcome some of the issues we see today. And that's really the final remarks. So developing economies are really impacted by the common assumption of uniform cost of capital. We're seeing that about 30% or more green electricity is assumed when financing conditions are not considered. So again, if we rely to current estimates, we are really underestimating quite a lot the cost and the pace of the low carbon transition in developing economies. Moreover, our analysis shows that early action to improve financing conditions could have really a strong impact on the speed and the timing of the transition. And we showed that net zero can really be achieved 10 years earlier in Africa compared to the current basically values. In order to achieve those results, it will be really important to have really radical changes in the current financial frameworks. And again, I here mainly referring to, for instance, the European framework for sustainable finance, because it's almost completely missing the country dimension in the framework. And I guess it will be important really to avoid this sort of idea of the climate investment trap. So we really need to find mechanisms and ways to trigger investment by improving access to finance. And I guess especially the COVID give us really an opportunity to reframe the international market finance and to make it more really a lower cost of capital for developing economies. Thank you a lot. I just want to acknowledge that this research was supported by quite a few European projects and also UK projects. You must also have seen that the title has changed because the analysis has been just published in a paper in Nature Communication literally a few weeks ago. So if you would like to read or to know more detail, just get in touch with me, or you can really read our paper. Thanks a lot, and happy to take any question.
Thank you, Nadia, for presenting the impact of cost of capital on the decarbonization, especially in the emerging market. It's a very interesting research piece. And let's see if we have questions for you. So while we're waiting, I have one or two questions. The first one, like as evidence shows that the financing cost is changing over time across countries. So how do you address this issue in your model? How do you like input like fixed a figure for a specific sector for the country, the fixed value of cost of capital, or do you do like average, like every 3 or 5 years? How do you address this?
Yeah, no, that's a very good point. I guess it's especially an important question consider the financial markets, how the interest rates changes over time, which is more, let's say, short-term indication rather than long-term. What we did in this analysis was to compute those values for a reference year, which was 2016. The dataset was finalized in 2017 and was based on basically all the values referred to the previous 12 months. So literally the 1 year, the 2016 year values. And then we input the data, and we, in the model, we start to simulate basically the scenarios over the years. So we didn't change, once the cost of capital was input into the model, fed into the model, we didn't change the cost of capital over time. But I do agree that this is a sort of really strong simplification because the cost of capital can change quite a lot, despite, I mean, I would say, what we want to capture is really the order of magnitude that you do observe quite a difference between developed and developing economies. And I guess in safest countries like Germany, Japan, the cost of capital is really low. It can be as low as 3%, while in developing economy, it's much higher. So I guess our analysis is able to capture this kind of order of magnitude, in the sense keeps the difference between the safest countries and the riskier countries. It doesn't account for the more dynamic values of the interest rates that may change, as I said, every year or literally every month that we observe in financial markets. So definitely this is a limitation which also we point in the paper.
Okay, yeah, thank you. Thanks a lot. And also, so another question is that which specific like power generation technologies are included in your sample as green or brown technologies, especially in the firm level? What's the criteria?
So I'm just resharing the presentation because I have a supplementary slide. I have a couple of supplementary slides, and one slide was exactly what you're asking for. This is a kind of table summarizing how we define the technologies in terms of low carbon and high carbon. So you see, mainly in the low carbon, we have renewables, biomass, and energy storage, carbon sequestration, while fossil fuel generation, it goes in the high carbon along with nuclear power. That's yeah, the way basically we classified the technology. And this is also, I have to say that this is an assumption and an input that comes from the TM-UCL model. So yeah, it's somehow also the way the model works and is constructed. And then of course we computed the cost of capital accordingly.
Do you actually exclude for those firms actually covers both? For example, some firm like electricity, they do have some businesses in renewable and also have some businesses in fossil fuel. Do you actually exclude all those? So just
yeah, it's, I mean, the way it was done, it was a sort of an average of the cost of capital that those companies it will pay. So we took basically the average based on several data sets. One of the main one that we use data coming from Bloomberg and data coming also from other data sets like Anandarajah, who collect basically quite few data on the cost of capital across basically sectors based on the data of the companies and the firms that are working or are involved in the sector. So I do agree that there are some companies, they are involved in both business, especially now that we see the low carbon transition. So some, let's say, fossil fuel company are even involved in the transition. But that is sort of an average of the companies working in the sector. So I wouldn't say that we excluded, but we mainly took the average of those basically firms.
Okay, let's see if there's any more questions here. If there's no questions, I think we'll end it here. Thank you, everyone. Thank you, Nadia. That's a great presentation. Hopefully we'll get in touch later. Thank you. Thanks.
Thanks a lot. My pleasure.
Bye.